Join ninZaFamily. Download free indicators, settings, and chat live with pro traders. Breakout trading has always had a strong appeal. When price breaks through a familiar area, it feels like the market is about to make a powerful move, and no one wants to be left on the sidelines. But precisely because it looks so simple, breakout trading is also where many traders run into trouble. Not every breakout leads to a trend, and not every level that looks like a breakout is truly meaningful. We watch the price go up or down, look for swing highs and lows, draw out areas where the market has reacted before. And when the price breaks through those areas, we enter with the expectation that the trend will continue. That approach isn't wrong. But ask yourself a simple question. Are those areas really where the market cares, or are they just zones we've drawn? The reality is, many breakout areas only seem right after the price has already moved. We look back at the past, see price bouncing up or down from a certain area, and then assume it's a good place to trade. But when we're standing at the present moment, before the price breaks, we can't be sure that it's a meaningful zone. And even when the price breaks an old high or low, the familiar reaction of many traders is, breakout, let's jump in.
Okay.
A lot of people think that way. It's not necessarily wrong, but the issue is that not every breakout leads to a valuable move. When a breakout occurs, the market always presents two scenarios. One, the price moves quickly in the breakout direction, giving you the feeling that miss it and you miss the opportunity. Two, the price returns for a retest, creating doubt, anxiety, and sometimes even fear. And a lot of traders get shaken out of the market right at this moment. At this point, a more important question comes up. Where will the price retest? Is it here? Nobody knows. If we don't have a clear answer to that question, breakout trading will always feel like a gamble. The core issue isn't whether you're trading breakouts or not, but what you're using to identify breakouts. The market doesn't break out randomly. Before each move, there's always a phase where the price stops, consolidates, and forms balance. Only when that balance is broken does the market start to show a clearer intent. If we can objectively identify this balance phase, know its boundaries, and understand the price level the market accepted the most during this phase, breakout trading will no longer be guesswork. Flex TPO was created based on that idea. Instead of drawing breakout zones based on gut feeling, it uses the concept of initial balance from market profile to automatically identify the market's initial balance zone for each time cycle. Not only does it draw the boundaries, but the indicator also uses TPO to identify the point of control inside the balance zone. This gives you a clear reference for breakout observation and, more importantly, it gives you a spot to look for a retest signal after the breakout. Flex TPO is built around three core components, each designed to answer one critical question in breakout trading. The first component is initial balance. This is the price range formed during the early part of a cycle, where the market temporarily reaches a balance between supply and demand. Flex TPO uses initial balance to define the boundary of balance, helping you identify when the market is still undecided and when it begins to move away from that state. Instead of drawing levels based on subjective swing highs and swing lows, initial balance provides an objective reference framework for observing meaningful breakouts. Inside the initial balance, Flex TPO uses a TPO chart to visualize how the market allocates time at each price level. Each letter represents a unit of time spent trading at that price. When these letters stack on top of each other, they form the POC, point of control, the price level most accepted by the market during the balance phase. The POC acts as the value axis of the initial balance, helping you understand the central price that the market is most likely to revisit after a breakout. Based on initial balance in the POC, Flex TPO generates two clear action signals, break and retest. A break occurs when price closes outside the initial balance, signaling that the market is leaving balance and beginning to express a clearer directional intent. After the break, if price returns to the POC, Flex TPO marks a retest, a key area to observe market response, and avoid chasing price immediately after the breakout. That's why Flex TPO doesn't try to predict where the market will go. Instead, it helps you answer the three most important questions. When is the market ready to move? And where is it breaking from? Justin, if it comes back, what's the key price level? Join the ninZaFamily forum to stay connected, ask questions, and explore ideas with our team and other traders. There's a lot more waiting for you inside. Links in the description. Thanks for watching until the end. If you found this video helpful, don't forget to hit the like button, subscribe to our channel, and ring the bell icon so you don't miss our latest content.